Folks, second to last class. That's the good news, that's the bad news. We're almost done. That's the good news. The bad news is we're almost done. Okay? So reminders in case you need some. So let me roll them out one at a time, because it's going to, by the time I get to the fifth one, you're going to say, oh my God, he's piling on, and I am. So what's the first thing that's due? The project which is due on Monday at... No, the project is due Monday. The summary of the data is due by Sunday. Okay? So let's get this right. The actual full project is not due till 5 p.m. on Monday. And I don't want anybody missing class on Monday because you're working on the project. Because if you're working on the project at 1 p.m. on Monday, you put this off way, 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 way too long. So you should be pretty much wrapped up by Monday. So maybe the last dot, and you're not printing it off. You're sending a PDF. Please send, I'd prefer your file. I'll send you the details. Just send the files as PDF files. It's easier for me to put comments than in Word files or in Excel files. So send your final project as a PDF file. What's the page limit? Do you remember? It's 20 pages. Fernando's not been reading my emails, obviously. So it's 20 pages is my page limit. It's if you have 5 companies. For every extra company, I'll give you 2 extra pages. I'm doing this to protect you. Really, it's for me, but I have to act like it's for you. The reality is if I don't do this, some of you are going to go crazy and write War and Peace over and over again, 1,000-page reports. So by Sunday night, if you can send me your numbers. And if you took a look at the summary sheet I sent you, and I'll send it again just in case you've lost it already, all I want is 6 numbers on your company. Your DCF value, what DCF model you used, so you can call it 2-stage. So don't get too caught up in the type of model. I'm more interested in, is it a dividend model, a free cash flow to equity model, or a free cash flow to the firm model? A pricing for your company. And many of you I know have been struggling with this part because depending on how you or who you compare your company to, you can get very different pricing. Pricing against a small sector, big sector. You know, Luis is doing Tesla against the auto sector, against the tech sector. You can get different pricings. You get to decide which of these different pricings you want to hang your hat on. Give me that pricing and what multiple you used to get there. And if your company is one of those few companies where you can actually use the option pricing model, which is going to work only if you have a lot of debt and you're a money-losing company, then give me the option value. For most of you, there'll be nothing there. So for most of you, it's only 4 numbers. And then in the final column, I ask you for your recommendation. Buy, sell, hold. No strong buy, no semi-strong buy, no weak buy, no really weak buy. Buy, sell, hold, right? 3 choices. That's it. So basically, if you can give that to me by Sunday night, what I will do is I will take the summaries you send me, and Monday's class will be just about you seeing what you found in this class. Okay? So that's the project. Your final exam is a week from the next Monday. Right? That's your official final exam day. It's the 15th. It's from 1 to 2:50, I think. That's the actual official time. I don't know why undergraduate classes go an hour and 50-minute finals, and the MBAs are 2-hour finals, but it's an hour and 50-minute final. I don't know what's on the final because I haven't written it yet, so sometime this week I have to write the final, if I remember to write the final. There is an early version of the final, which is going to be May 11th, right? And the Google spreadsheet for you to sign up is there. I see about 40 names. I can have up to 50 people in the early final. So if you have to take the early final because you're leaving on the 12th or the 13th on a flight, you need to get out, sign up for the early final. And the final exams are going to be comprehensive. They will cover everything we did in the class. We have only like 750 lecture notes, slides. So don't expect to come looking for something in the slides at the exam. You're never going to find it. But it'll cover everything we did in the class. I'll talk a little bit more about the final exam on Monday. Okay? So let's put the bow on the class by talking by connecting the 2 classes. I mean, as many of you know, I teach 2 classes. I teach a corporate finance class and I teach a valuation class. In fact, as I look out, I see quite a few of you are in both classes. Today's class is one of the few chances I get to bring them together. So what I want to talk about today is value enhancement. So I'll talk about what exactly that is, but let's start with the usual start of the class test. Okay? So let's assume that I come to you and ask you a question about, I want to increase the value of my company. So I'm going to list a series of actions, and I want you to tell me which of these will enhance value. To kind of think through this question, remember what drives value. What are the three things that drive the value of a business? Cash flows, growth, and risk, right? You can dance around them as much as you want. So as I list off each of these actions, I want you to think about how does it affect cash flows, how does it affect growth, how does it affect risk. A stock split. What does a stock split do? First, what's a stock split? What happens in a stock split? Basically, a company takes 100 million shares, and if it's a 2-for-1 stock split, makes them 200. So if you own 10 shares, used to own 10 shares, you will now own 20. So how does a stock split affect the cash flows of a company? Come on, don't think too long. It does nothing, right? It just changes the number of units in the company. What does it do to the growth of the company? It's not reinvesting more, it's not reinvesting better, it does nothing for growth. And what does it do to the risk of the company? Again, nothing's changing about the risk. A stock split is a completely value neutral action. What about amortizing goodwill? Accountants make a big deal about it. It's called impairing goodwill now. I'm going to write off $3 billion. First, does impairing goodwill affect your cash flows? Let me rephrase the question. What has to be true about goodwill impairment to affect your cash flows? What are you doing when you impair goodwill? You're saying, I made a mistake 3 years ago. I paid $3 billion too much. I'm going to take that off the books. Right? For that action to affect your cash flows, what has to be true about the impairment? First, are you spending $3 billion when this impairment is done? Are you going to spend $3 billion today? No, that was done 3 years ago. But if it is tax deductible, then it could affect your cash flows, right? Because then I will save on taxes. Most goodwill impairment, in fact 99% of goodwill impairment is not tax deductible. So all it is a purely cosmetic action. You're writing off $8 billion. It's a huge number, writing off $8 billion. But you know what the market says? We knew that already. We knew you screwed up 10 years ago, 5 years ago, 3 years ago. So amortizing goodwill does not affect your cash flows, does not affect your growth, does not affect your risk, should not affect value because there's nothing there. Sometimes companies maintain two different depreciation methods in their tax books and their reporting books. The reporting books, they will choose something different from the tax books. So let's say in your reporting books, you've been using accelerated depreciation, which means you're taking more depreciation up front, and you decide to switch to straight line depreciation, just in your reporting books. Why might you want to do that? Why might you want to switch to a more spread out depreciation? What does it do to your earnings when you do that? You take a higher depreciation, you replace with a low one, it actually makes your earnings look better. So you're doing this to make your earnings look better. But you're doing this only in your reporting books. So what does it do for your cash flows? Absolutely nothing. In your tax books, you're still claiming the old depreciation. It does nothing for your cash flows because your earnings are still your earnings, your taxes are still your taxes. It has no effect on cash flows, no effect on growth, no effect on risk. You've heard of tracking stock. In the late 90s, companies used to issue tracking stock against just their online businesses. New York Times Online, for instance, in the late 90s, New York Times issued shares against their online business. You're saying, why would they do that? It was the dot-com boom. By issuing tracking stock, you basically told people, look, I have this valuable business. But from the perspective of investors, nothing changed. The day after you issued tracking stock, your company looked exactly like the day it did before. Okay, no effect on cash flows, no effect on growth, no effect on risk. None of those actions affect value. Tomorrow when you open up the Wall Street Journal, do open up the Wall Street Journal. I hope this becomes part of your day. I mean, when I say open, I'm not one of those people who reads the Wall Street Journal for 2 hours. I open the Wall Street Journal, I browse through stories. Tomorrow I want you to browse through stories, and as you browse through stories, here's a question I want you to ask. You'll see this extended story going 3 pages. Ask yourself, is this story going to affect the value of the company? And if the answer is no, you know what your follow-up should be? Why am I wasting my time on the story? Let me move on. Lots of what we talk about in markets have no effect on value. We're just wasting our time. So none of these actions affect value. Let me restate the question. Could any of these actions affect the price? Can a stock split affect the price? Sure. Why? Because pricing is about mood and momentum. Maybe offering people 5 times as many shares makes them feel good, and they push up the price. You could be writing off goodwill. Everybody knows it's a past mistake, but people still act like it's a fresh mistake. They could drop your stock price. When we talked about the value game and the pricing game, there are things that can affect value that don't affect price, and there are things that affect price that don't affect value. And one of the things we're going to talk about today is how do you enhance the value, and one of the things we're not going to talk about today is how do you enhance the price, and I'm going to explain why I wouldn't focus on it. So now, let's assume this class is over. You go out there, you develop a reputation, and I hire you as a new CEO because of your corporate finance expertise. So this is the company you're going to come in to run, and I want you to look at the 4 businesses that are very creatively labeled A, B, C, and D that are part of this company. Okay? So I'll give you the specifics on each of these businesses. I've given you the return on capital in each business and the cost of capital of each of these 4 businesses. You're thinking about divesting one of these businesses. Which of these 4 businesses would you divest? Johan, you're going to be my CEO. Which of these 4 businesses would you divest? Before we do that though, which is your best business? A. And what is it about A that makes it your best business? The spread you earn between your return on capital and cost of capital is huge, right? You're earning plus 10%. Which is your worst business? D, because you're earning a return on capital way below your cost of capital. This seems like a setup, right? It looks like LeBron James going to the hoop with nobody between you and the basket. So be LeBron James for a moment. Which of the businesses would you divest? Your best business, your worst business, your average business? You think you should do D, right? Because that's what we're all told. Get rid of the bad business. What is the effect of divesting a business on your value? What happens when you divest a business? The bad business leaves you. What do you get in return? Cash that somebody paid for the bad business. The effect on your value is going to be the difference between the value of the bad business to you and what you get as cash. You see where I'm going next? When you try to sell your bad business, does everybody in the world know this is a bad business? Absolutely, right? It's been screaming out, I'm a bad business for the last 10 years. When you try to sell the bad business, what are people going to pay you? A really low number because it's a bad business. Here's the great irony. What do people overpay for? Businesses that look great or businesses that look awful? In fact, the business you're most likely to get a value, because the effect on your value is what people pay for your business relative to what it's really worth. You're more likely to get more for a business, for your very best business, rather than your very worst business. It sounds like completely, but if you think about it, today the Yankees wanted to trade one player and get the maximum in return for that one player. Who should they trade? You have no idea. If you've not followed baseball, you have no idea what the question is even. They should probably trade Aaron Judge. He's a superstar after 25 games. He's had 12 home runs in 25 games. You know why? Because right now, his prices, people will give 3 stars in return for him because he's at his, in terms of what people see as his potential, that's what you're going to get. It actually makes you rethink what you need to do in a restructuring, because in a restructuring you're told, sell your bad businesses, keep your good businesses, but that's not what's going to affect your value. It's what other people think about these businesses and what you get for it. Let's move on to another question. Okay? Let's suppose you have a company with 200 million in debt, 800 million in equity. Its debt ratio right now is 20%. And let's say its optimal debt ratio is also 20%. So they're at their optimal, right? So the CFO says, look, investment principle, financing principle, dividend principle. Nothing I can do with financing. I'm at my optimal already. So let me ask you the follow-up. If a company is already at its optimal debt ratio, is there anything else you can do about debt that could affect its value? Clearly, you don't want to borrow more because you're at your optimal. Is there anything you could do in terms of helping this company on its financing that could affect its value? Anybody remember the financing principle that we did in corporate finance? There were two aspects to the principle. Ari, you probably remember. First was you want to get to the right mix of debt and equity, right? What's the other one? What kind of debt should a company take? Does anybody remember? You want debt that matches up to your assets. Remember, if you have long-term assets, you want long-term debt. If you have pricing power, you want floating rate debt. So there are two halves to getting financing right. One is getting the right mix. So this lady has already picked the right mix. But the next question you've got to ask is your debt right for you? And to do that, you've got to look at the maturity of the debt, whether it's fixed or floating rate, what currency it's in. Look at its asset. If it's mismatched, if you can fix the mismatch, what have you done for them? What's the benefit of matching up your debt to your assets? What does it do for you?
There's less risk.
Less default risk, which shows up. Let's make this tangible. So where does it show up in my valuation? There's less default risk because I've matched up my debt. My cost of debt should do what then? It should go down. My cost of debt goes down. Holding all else constant, my cost of capital goes down. My value will go up. So don't just look at the debt ratio. It's also what kind of debt you have as a company. And finally, I'm going to ask this question, but I'm going to change the company and change the number. Did any of you see the Apple earnings report last night? Okay. Just came out, most recent earnings report. You know what their cash balance will increase to after the most recent earnings report? It will be more than $250 billion. Okay, so they have $250 billion in cash. So here's my question. If they decide to return $100 billion of that cash to investors, either in dividends or in buybacks, and you are an investor in Apple, will you be better off, worse off, or neutral to that action? You see my question? There's $250 billion in cash. If they choose to return a big chunk of that cash to you as investors, are you going to be better off, worse off, or unaffected by that action?
Immediately maybe better off, but if they could use that cash for something smarter that there's more value, then...
Right. But let's in fact take that off the table. Clearly there's with that much cash, they're finding it impossible. So let's assume that they don't have investments that can earn more than the cost of it. So there's really no good use for the cash. Right? So we've taken that off. Would you now be better off because they don't have that? Okay. Tell me before they return the cash back, how did it show up in your investment, the fact that they had $250 billion in cash? No, but from your perspective, all you have is shares of Apple and a share price. Did it show up in the share price when you paid 145 or whatever it was? Is it in that share price? Some chunk of it has to be, right? $250 billion is a lot of cash. And in fact, if it's fairly priced, the way we do DCF, we just add the cash balance. The entire $250 billion could be built into your stock price. And in fact, if you take the $145, about $50 per share is pure cash. That's just the $250 billion divided by the number of shares. So right now, you're not paying $145 for Apple. You're paying $95 for Apple's operating assets and $50 for the cash balance, right? You do a buyback. You reduce your cash balance. The day after, you do the buyback, and let's say that, let's make it a special dividend because it'll make it much easier. You pay a special dividend of $25 per share. So the day after you get the special dividend, I'm going to come and check on you. What's different now? You have $25 in cash you got from Apple. That's the good news. What's the bad news? The cash balance is now lower. So when I look at your stock price, if it also drops by $25, you in effect are exactly where you were the day before. A buyback will be neutral news in a company where cash is valued as cash. So if the $250 billion is valued at $250 billion, a buyback by itself is doing nothing for you. It just means more cash in your pocket, or a special dividend is doing nothing for you. It means more cash in your pocket, a lower stock price, and you gain nothing. But so when will a buyback increase the value of a company? What has to be true about the cash balance then for it leaving the company to make you better off? Do you remember? Yeah. In other words, if you have a bad reputation as a management, a company where I think management will waste my cash, the 250 billion in cash might be valued at only 200 billion, and when you return the cash, I'm going to take that discount out of the cash. I think that is the argument we should be having about companies, not is this a lot of cash? Of course it's a lot of cash. Yesterday, the Wall Street Journal actually listed all the companies that Apple could buy with its cash balance. I don't even know why they wasted their time. In fact, if I've been pretty, I'd list all the countries they could buy with 250 billion in cash. If you look at the GDP, I mean, of countries, 250 billion, we get to like 60 of the 145 countries. You can buy Venezuela. That's with just penny change. Interest income on the cash. So go buy Venezuela for me. But we're missing the point when we make that about, is this a lot of cash? Of course it's a lot of cash. The real question should be, as an investor, do I want that cash to be returned? And on that, the answer is much fuzzier. Yeah.
So I think I remember you said that it's pretty hard for Apple, for someone to actually extract that cash out of Apple.
Mm-hmm.
It's too big to buy. So is that like the chance of like extraction in there or not? Because
Here's what I'm going to cut Apple some slack, right? Has Apple been trying to return cash to its stockholders? It has returned $300 billion in cash in the last 5 years. It has returned more cash than the next three companies put together. $100 billion in dividends and $200 billion in buybacks. So the reason I cut them some slack is they're trying. Here's the problem they have. They're funneling out cash as fast as they can, but while they're funneling out the cash keeps coming in even faster. This is a great problem for a company to have. They can't get the cash out faster. And they face one big constraint, which keeps them from touching the 250 billion. We talked a little bit about this. Do you know what that constraint is? Why is that 250 billion not available for dividends and buybacks right now? It is trapped, right? 220 billion of that 250 billion is trapped outside the US because of the tax laws that the US has. So for the moment, I can see why their cash balance is high. And from an investor perspective, it's not on my top 5 list of worries about Apple. Here's what scares me. You know what I don't usually listen to CNBC ever, but yesterday people kept sending me clips of CNBC. There were 5 different analysts on CNBC yesterday, and each suggested a different company that Apple should buy with their 250 billion. One suggested they buy Tesla. Yeah, right. Apple buys Tesla, Elon Musk now becomes part. No, I don't want that, right? Now, Elon Musk is a great visionary, but not exactly a team player. One suggested that Apple buy Disney. Hey, 250 billion, you can buy Disney. It's a $120 billion company. Okay? One suggested they buy Twitter. Okay? Why would you want to mess with Twitter? But basically, each listed off. And my point was, please, God, don't listen to any of these people. And why? We spent an entire session talking about the incredible success acquisitions are, right? Not. The last thing I want Apple to do is go do a big acquisition, because this is going to be the reason why I won't trust Apple. If Apple really wants to destroy trust, all they need to do is do one big acquisition. And then you're going to see some really pissed off investors saying, we want the cash back. They've shown incredible discipline as a company. And for that, if of all the things I would give Tim Cook credit for, this is the biggest one. Can you imagine how many bankers probably visit Apple every day saying, hey, do you want to buy something? We have exactly the thing you want. We don't know what it is, but tell us how much money you want to spend. We'll find something that fits just right. It's incredible discipline they've shown. And for that, I credit them. And but I think this is an issue that's going to come back later this year, because if the tax law does change, and there's a very real chance that the law on foreign income will change, you're going to see perhaps the greatest buyback in history. You could see a $150 billion buyback. Okay? But for the moment, they can't do that with the tax laws. Yes?
Do investors put a discount on trapped cash?
That's a good question. We don't know, right? Because all we observe is the overall market capitalization of the company. From my very limited look at companies with big, it doesn't seem to be. And here's why. Historically, Congress has always blinked. You know what I mean by this? 10 years ago, Congress passed a one time, never again, one time. Just bring your cash back, don't do it again. And they've done this once every 10 years for the last 30 years. It is incredibly stupid because if you're a company, what are you doing then? You know there's going to be an escape hatch 6 years from now. You wait, and they say one time, don't do it again. Say, of course we won't do it again. We'll bring it back, never again. 10 years later, you're back at the table again. So investors just don't believe that the US Treasury can ever collect the taxes on trapped cash. So unless you're the kind of company that absolutely has to bring the trapped cash home for some operating need, investors don't seem to be punishing that cash. But that's a good question. And why do you ask that question? What's the follow-up? As an investor, if investors are in fact punishing companies with trapped cash right now by discounting, you know what I've been punishing? They're discounting the cash by, let's say, 10% because of the expected taxes, and you think the tax law is going to change, what are you going to do as an investor? In other words, go screen in Capital IQ for companies with the biggest foreign trapped cash. It's kind of tough. You'll have to find the foreign subsidiary cash. No. Find those companies, invest in 10 of those companies, sit and hope that the tax law actually changes, and if you're right, the discount should disappear and you should be able to make money. So that's actually a very good way to think about trapped cash, is what are investors doing about it and what can I do to exploit that? No, wait, don't go there, right? When we say trapped cash, where's that cash trap? What is Apple doing with the $220 billion in trapped cash? Where is it invested? Is it kept in a bank account somewhere? Imagine going to the bank and say, I have a checking account for $250 billion. The bank would love it. It's not in a bank account. It's actually invested in marketable securities. Liquid and close to riskless. So let's start with the bad news. What interest rate do you think Apple's earning on that trapped cash? Maybe 1%, 2%. You think that is horrible. But what return would we make if we invested in something liquid or riskless right now? 1 or 2%. So it is not really leaking value because it's invested in marketable securities, earning a fair rate of return given what it's invested in. Cash doesn't hurt you, as long as it's not wasting, as long as it's not sitting around as currency somewhere. That's why, as an Apple stockholder, as I was until a couple of weeks ago, as an Apple stockholder, the $250 billion was not my worry. My worry was what they might do with the $250 billion, that big acquisition that they could screw up on. But by itself, cash just sits there. It's a neutral asset. Yeah.
Does cash ever come into an optimal portfolio? Like, as an investor, do I ever want cash in my portfolio?
Of course you do, right? Because why do you need cash? Why does every investor, when they put their portfolio together, have some of their money in cash? Because you could get sick tomorrow. Liquidity needs, right? We all have liquidity needs. When I invest my family's money, I have to set aside enough money in liquid and riskless investments to cover my liquidity needs for the next year. So if I feel I'm building a house and I need $100,000, I don't want to invest that money in stocks, because to sell stocks 3 months or 6 months from now, who knows what the market will be at. So some of your investment, every investor's portfolio is in cash. It takes the form of money market funds or something liquid and riskless. So we all are invested in cash. My point is, if you own Apple stock, you already have a cash balance in your portfolio. You just don't know it as part of that stock price.
And it could be the case that the portion of your assets you're allocating as cash to cash is higher than you would desire.
That could happen. That could happen. And why would you do that? Why would an investor hold more cash than they really need in something like money market funds? Why might you do that? What if you think the stock market is overpriced, right? You think there's a bubble in the market. What are you going to do? You're going to pull your money out of stocks, and you're going to hold it till the bubble goes away. So in fact, if you're timing markets, that's how it's going to show up, is you're going to be taking money out of those markets that you think are overpriced, the stock market, the bond market, and you're going to hold them as cash until the overpricing goes away. In fact, let's close the loop there. What is the danger of doing that? Seems like a prudent thing to do, right? Right now everybody's talking about the market being in a bubble. So why shouldn't I just sell off all my stocks and just hold cash? Want to try? What do I lose by doing that? Yeah.
You can kind of just hope that you can ride it right until the end and then pull everything
fact, when you talk about market timing, if the market is not in a bubble and you've taken your money out of the market and put it into cash, you're going to be sitting there saying, any day now, any day now, any day now. There are people in this market that I know left the stock market in 2011 because they told me the market is overvalued. They've been in cash now for 6 years saying, any day now, any day now, any day now. Someday the market is going to drop by 30%. It's a given. That's the nature of equity markets. And so I told you so. Let me ask you a question. Is it worth being out of the crash if you had to spend the 10 years leading into the crash being in cash? And my answer is absolutely not. In fact, I have a spreadsheet attached to a blog post from a couple of years ago where I said, okay, let's assume you think the market's in a bubble. How quickly does the bubble have to burst for you to actually act on that belief that you think market's in a bubble? And it turns out the bubble has to burst within 2 years for it to actually pay off for you to pull out of the market today and be in cash, because if it takes more than 2 years for the correction to happen, what you lose by staying out of the market is actually greater than what you gain by not being in a crash. The 2008 crash, do you think I lost money in that crash? Of course I did. Who didn't, right? Would I have wanted to stay out of the crash? Yes, if you could have just got me out of that last 3 months in 2008, that would have been so good. But I know what would have happened. If I wanted to stay out of the crash, I'd probably have left the stock market in 2006, and I probably wouldn't have got back till 2010 and got out again in 2011. That's what market timing does. It makes you leave the market because you have a point of view in the market. And if you're doing that, you better be clear about how good you are at market timing, because what you lose by staying out of the market can be greater than what you gain. So let's start. Yeah, go ahead, Luis.
Does that not depend on how much the market actually drops?
That depends. If it's a Great Depression, obviously, but if you take the history of markets, you can't invest like the Great Depression is going to be tomorrow. Because if you do that, you're going to be in cash for the rest of your lives. And let's face it, a lot of people after the Great Depression, it took people almost 25 years. If any of your grandparents, great-grandparents grew up in the US and they went through the Great Depression, talk to them about investing. They're much more risk-averse if they lived through the Great Depression than they were if they were born after that. Because it kind of... So it does create the trauma if you've been through that big event. Just like people after the 2008 crisis were a little scared for a few years after. You're right, if it's an 80% crash, then obviously you want to get out. But not only do you then have to predict the next crash, you have to predict how big it's going to be. Okay? So let's talk about value enhancement. And I first want to draw a contrast between value enhancement and price enhancement. You're saying, what the hell are you talking about? I'm going to talk about a research paper that was written in the late 90s. It was called A Rose by Any Other Name. And here's what the paper did. It found a sample of about 60 plus companies that changed their names. You see, what's a big deal? Companies change their names all the time. These 60 plus companies changed their names by adding .com to their names. Whatever their name was, added .com, and they changed nothing about the business. So yesterday you were a warehouse company, today you're a warehousecompany.com, but you're still a warehouse company. So let's get the first part out of the way. If all I do is add .com to my name, have I changed my cash flows? Have I changed my growth? Have I changed my risk? Not really. But guess what happened to the stock prices of these companies when they added .com to their names? They increased on average by 120%. Many of these were tiny companies, so keep that in perspective. So all they had to do was add .com. The price jumped 120%. You're saying, that's crazy. That's the pricing game. You're saying, let's just play this game. To kind of tell you why you shouldn't play this game, this is another study that was done 3 years later. This is after the .com boom had bust. It looked at maybe 50 companies that changed their names. You know how they changed their names? They took .com out of their names. Because now .com had become this bad name to have. When you took .com out of your name, stock price jumped again. This is the pricing game, and essentially it shows you why I don't want to play the price. I have no idea how you keep markets happy, because that's how you play the pricing game. What do you want? What makes you happy? I'll give it to you. And for a while it works, but markets are mercurial. They change their minds, and the next thing you know, what worked last year will no longer work. So I want to focus on what I can focus on, which is value. So let me set up the framework for how to change the value of a business. If you look at the value drivers for a business, there's expected cash flows, there's a growth period that you have, a growth rate, and basically at the end of the process, a cost to capital, a discount rate. To change the value of a company, you have to change one or more of those four inputs. You either have to increase your cash flows, increase your growth rate, reduce your cost to capital, or increase the length of your growth period. I'm going to take everything I know about restructuring and put it into one of those four buckets. So let's start with the first bucket. You've been called in as a CEO of a company and given the mission of increase the value of the company. The first place you could look is existing cash flows. And the question you're asking is, can I increase my existing cash flows without affecting the future growth? So let's go through some of the things that you will see in the context of a restructuring. First, you'll hear the word more efficient operations and cost cutting after every business a new CEO comes in. What I hear is higher margins. That's because if you mean what you say, when you cut costs, your margins go up. Higher margins beget higher operating income. Higher operating income becomes higher cash flows. That's the first one. The second is if you have businesses that are losing money, that you expect to lose money forever, shut them down. You say, why wouldn't somebody have done it already? Because people hate to admit mistakes. That's why so many divestitures happen when a new CEO comes in, because a new CEO has no qualms about admitting to the old guy's mistakes so that he can clear the table to make his own. So get rid of businesses that are losing money. What I'm going to say next is going to sound mildly unpatriotic or massively unpatriotic, but take it for whatever it's worth. I have never believed that it should be the objective of any company to maximize taxes paid to the government. You might believe otherwise. But here's what I believe about taxes. I believe you should follow the law and minimize taxes paid given whatever the constraints of the law are. I told you to sound mildly unpatriotic. Bernie Sanders, if we were sitting in this class, would probably be jumping up now saying, you can't say that. Okay? So if you can reduce taxes paid legally, look how well I'm covering myself, right? I don't want any of this to go out there and say, he suggested you cut taxes, cheat on taxes, tax evasion. If you can reduce your taxes legally, all the more power to you. And let's think of some of the ways you can reduce your taxes. You can pull a Bjorn Borg. You have no idea what I'm talking about, right? I used to play tennis a long time ago in a previous lifetime. And I learned tennis on clay courts, and I played, I got to Wimbledon in 1976 for the first time, just to watch. You can't play on grass, it's for cows, So basically, so I get up, show up in Wimbledon in 76, and of course Wimbledon is always raining and everybody's eating strawberries and cream, but it's the atmosphere, I guess. And in 1976, a 17-year-old Swede called Bjorn Borg came out of nowhere to win Wimbledon. I remember watching him on Central Court. It's the most unconventional, because he had these big loop, but he was able to play on clay. Usually when you have big looping, forehands like. But he played from the baseline. He won Wimbledon in 1976. I went back home, and then 1977, I didn't come to Wimbledon, but I kept reading the news. In 1977, Bjorn Borg wins Wimbledon again, and I look at the headlines. It says, Bjorn Borg of Monte Carlo wins Wimbledon. I said, what happened here? Did Monte Carlo invade Sweden while I wasn't watching? So what happened between 76 and 77? Here's what happened. In 1976, when Bjorn Borg won Wimbledon, the highest marginal tax rate in Sweden was 92%. At which point you're saying, why are you even mailing me the check? Just give it to the tax guy. Right? Basically, it comes to me, I pass it on to you. So somewhere in 76, Borg started thinking, do I have to be Swedish? I know ABBA needs to be Swedish. I don't have to be Swedish. I could be Monte Carlan. I don't even know whether that's the right word for somebody who lives in Monte Carlo. He pulled a Bjorn Borg, basically moved to Monte Carlo because they had lower tax rates. You're saying, companies can't do this. Hey, that's what Pfizer tried to do with Allergan, right? Pull a Bjorn Borg, move to Ireland, reduce taxes. If you can move to a different locale with a lower tax rate, of course you should do so. If you're a multinational, you might not even have to move. Through the magic of transfer pricing, it's amazing how you can move income to your lowest tax locales. You know what transfer pricing is? When you have a big multinational, the transfer pricing is the pricing for intra-company services. So let's suppose that I am YouTube and I'm part of Google. If I'm doing transfer pricing, there are any transactions between YouTube and Google, and there are dozens and dozens, the transfer pricing is the prices you set for those transactions. You see how you can use this to move income from high. So if YouTube is an Ireland-based company and Google is based in the US, whenever YouTube does anything for Google, it's going to premium price the product and collect much higher revenue. So by the time you're done, your income has magically moved to Ireland, your expenses have magically moved to the US. Transfer pricing basically reduces taxes. Risk management, I'm not a great fan of risk management. One of the good things that comes out of it is you smooth out your income over time and maybe reduce your tax rate. So you can try to improve margins and increase your operating income. You can try to reduce your effective tax rate and increase your after-tax operating income. If you overinvest in the past, live off the fat for a while. If you're at 300% capacity, why do you keep building new factories? So basically, you can get the depreciation from past capex and have very low capex for the near term. And finally, if you're a company that has very big working capital needs, maybe by cutting back on your inventory, managing inventory better, you can increase your cash flows. You know, until Walmart came along, the conventional wisdom with retailers was you were supposed to have a current ratio of 2. What does that mean, a current ratio of 2? I remember taking my accounting class and thinking, what is that? So when you say current, what's the definition of current ratio? It's current assets divided by current liabilities, right? So the conventional wisdom in accounting was not a finance, was you should maintain a 2-to-1 current ratio. Until Walmart came along and said, why? They said, it's 2-to-1, that's what it is. So why? Do you see why for a retailer this is a huge penalty? Because if your current assets are twice your current liabilities, given how big both items are, your working capital needs are going to be huge. It's going to drain your cash flows. Walmart said, why don't we make it 1-to-1? That way our current liabilities pay for our current assets. We have no working capital needs. That's going to release about $3 billion in cash flows. If you can manage your working capital better, you get higher cash flows. So if I came to you with a mature company which is inefficiently run, this is the first place you're going to go to create value, right? You're going to see if you can get higher cash flows from existing assets. So that's the first stop. Look at the existing assets, see if you can get higher cash flows. Here's the second stop. Yes?
Can we please go back to the past one?
Mm-hmm.
Okay, so when you do transfer pricing, you create more trapped cash, right?
You could.
And say you create so much trapped cash in the foreign subsidiary, would you not be able to invest that cash?
That could happen. That could be one of the penalties of using transfer pricing a little too enthusiastically. You could end up with a lot of trapped cash. In fact, technology companies, have you noticed, are among the biggest companies with trapped cash because it's easier for them to do transfer pricing because nobody's quite clear about what these services even look like. Because the IRS often tries to come to Google and saying, you're overpricing the service. But Google says, you don't know technology. That's how much it costs to move from one server to another. The IRS says, really? Okay. So that's the problem. Whereas if it's an automobile company trying to do transfer pricing, if they're charging $250,000 for a car, the IRS says, no. This is a Chevy Volt. It's not $250,000. It's much more difficult for manufacturing and tangible product companies to do transfer pricing to the extent that technology companies do. But you're right. One of the penalties is you might accumulate cash in those foreign locales. But if you're going to save 23% in taxes, hey, you know what? I'll accumulate a lot of cash before I start worrying about that. Yeah. Let's talk about increasing value, increasing growth. The way we've defined growth, it's a product of how much you reinvest and how well you reinvest, right? In fact, it's not even that you want to increase the growth rate. You want to increase the value from your growth. The reason I want to phrase that is if you're a company that is reinvesting a lot in projects that earn less than the cost of capital, and you want to enhance value, what should you do? You want to cut back on reinvestment because this reinvestment is destroying value. So if you're a company that's in a bad business reinvesting a lot, and I'm your new CEO, I'm going to come and say, stop, no more reinvestment. If you're a company that's reinvesting a lot, but in a business where the return capital is higher than the cost of capital, then we can talk about how can we increase the value from growth by either reinvesting more or reinvesting better. Reinvesting more shows up as a higher reinvestment rate. Reinvesting better shows up as a return on capital. In fact, you can actually take the return on capital and break it out into two components. One is the operating margin, the other is the sales to capital ratio. In fact, if you take the product of those two, the capital turnover ratio, you essentially can end up with your return on capital. In marketing, often you're given a choice between high price, low volume strategies and low price, high volume strategies. High price, low volume strategies, you charge a high price, you don't sell very much. You have high margins and low turnover ratios. Low price, high volume strategies are like Walmart. You sell at low margins, you sell a huge amount, you make the turnover ratio makes up for it. So essentially, when you pick between marketing strategies, this becomes your tiebreaker. Which one will deliver the higher return on capital and the higher value? So let me complete that growth issue, because one of the mistakes we make often when we talk to companies, we talk about all of the great ways you can grow. You can do acquisitions, you can do this, you can do that. Okay? One of the good things that McKinsey has done actually is they've gone back in time and looked at the payoff to different types of growth strategies. Basically, they have like 50 years of proprietary history on their clients, so they can see what clients have adopted what growth strategies, and they've tracked which ones of these work the best and which ones have worked the worst. So I'm going to go from best to worst. Looking across their 50 years of proprietary data, here's what McKinsey found. The very best growth strategy in terms of creating value is to come up with a new product. $1 million invested in that strategy creates between $1.75 to $2 million in additional value. So give me an example of a company that has been incredibly successful by introducing new products. It's Apple, right? If you look at Apple, do you remember what the market cap for Apple was? Does anybody know what the market cap for Apple was in 2000? It was less than 10 billion. By 2011, that value was 620 billion. They went from less than 10 billion to 620 billion. And the way they got there was pretty much part of cultural history, right? It was first the iPod, then the iPhone, then the iPad. It was new product after new product after new product. So if you're a CEO, you're saying, okay, let's be the next Apple. What's the potential riskiness of this strategy? You could be the next Microsoft instead of the next Apple, right? How many new products has Microsoft introduced over the last 25 years? Too many to count. How many of them stuck? Not one. After Office and Windows, there's not a single Microsoft product. How about that Zune that you still own? Do you remember the Zune? Well, I remember the name. I don't even remember what it looked like. You're saying the Surface, this is going to be it. Maybe it will, maybe it will not. Microsoft's history is full of new products that didn't quite catch on. But if you can pull it off, new products that work, best possible strategy in terms of creating value. Next best is expanding an existing market, either geographically or by coming up with new users. Let's take the geographically. In 1981, Levi Strauss, which had been a company that had been around forever, was a mature, boring company. It was dying on its feet because it made jeans and people were not wearing jeans anymore. People were wearing designer jeans and names on the jeans, and nobody wanted Levi's. The way it kind of exploded out of that problem was it went global. It sold Levi's as a cultural, as much as part of culture as jeans, and it essentially became an incredibly successful company. It expanded the market by going geographically. Same thing with Coca-Cola in the 1980s. Mature market in the US went global, expanding an existing market. Next bit, and $1 million invest in that creates between 0.3 and 0.75 million in additional value. Maintaining or growing share in a growing market. You know that Google's market share of the online advertising market has been stagnant for the last 3 years? That's bad, right? But the online advertising market is growing about 20 to 25% a year. Your market share stays stagnant, you're going to be okay. So $1 million invested in a growing market, 0.1 to 0.5 million. And now come the two strategies that historically have not worked very well. The first is competing for market share in a mature market. $1 million invested in that, about a third of the time actually delivers negative value, minus 0.25 million. Sometimes it creates, but not as much positive value. So what's so difficult about competing for market share in a mature market? If you want to go for a higher market share in a mature market, what do you usually have to do? How do you get a higher market share of a mature market? You cut prices, right? So you get a higher market share, but in return for the higher market share, what do you give up? When you cut prices, your margins go down. The net effect is often negative, and that's what you see as a minus 0.25. And the last one, the very bottom of the list, should come as no surprise given how much I dumped on it in the last session. Historically, the worst way to grow is through acquisitions. I'm supposed to be in CNBC tomorrow at 5. I know they're going to ask me the Apple question. They're going to ask me this question of who should Apple buy. And I'm not even going to talk. I'm going to hold this graph in front of my face and say, what do you think? Eh? Who should they buy? Because you're scraping the bottom of the barrel. The history of trying to grow through acquisitions is not good. The history of trying to grow through big acquisitions is even worse. The history of trying to go through big acquisitions of publicly traded companies, let's not even talk about it. This is disaster land waiting to happen. Historically, growing through acquisitions has been the toughest strategy to pull off. So we won't talk about growth. Let's talk sensibly about growth. It's not higher growth per se, but the value of growth that you should be talking about. So now we've talked about how to increase cash flows, how to increase growth rate. Let's talk about increasing the length of your growth period. On your spreadsheet, what am I talking about? How long will growth last? Remember the question I asked you? 5 years, 10 years. And if you made it 25 years, your value went up even more. 50 years, even more. On a spreadsheet, you can make your growth period whatever you want, right? It's just an equation. But in the real world, here's what I think about when I think about how long can you maintain growth. I think about how strong and sustainable your competitive advantages are. The stronger and more sustainable your competitive advantage is, the longer you can grow. So if you think about value enhancement, what am I asking you? Is there something you can do in this company to increase its competitive advantages and make them stickier? And if your answer is yes, you just increase the value of your company. I'm not a corporate strategist, but here are some of the potential competitive advantages you could work on. If your company has a brand name that it has not used well, step up to the plate and use it better. We talked about Levi Strauss. Okay? If you think about some great brand name companies through history that have let their brand names essentially fade over time, and you're the CEO that's been called in, maybe you can recoup that brand name. And what does having a stronger brand name allow you to do? We talked about this in the context of value in Coca-Cola. It allows you to get pricing power, higher margins, higher value. So if you have a brand name that's been allowed to fade, try to bring it back. If you don't have a brand name and you can create one, here's where it's going to pay off. Right? The second is, if you can get protection against competition, that would be great, right? So can you get legal protection against competition? Can you get the courts to enforce your power? What sector do we see this already in? Whenever you see pharmaceutical companies, when you talk about patents, assuming the patents are enforced, you get legal protection against competition. Just be careful what you have to give up in return. What I mean by that, until about 30 years ago in the US, you had lots of regulated monopolies. You know what regulated monopolies were? The classic, of course, was AT&T. It was a regulated monopoly. It was the only company that could provide phone service in the US. It's a regulated monopoly, you see. What's the great thing about being a monopoly? Think like a monopolist. What is the best thing about being a monopolist? First, if you're a monopolist, everybody hates you, right? That's a reality. Like nobody loved Rockefeller when he was still alive. But if you're a monopolist and everybody hates you, you know how you get back at them? You charge them more. You hate me? 50% more for you. It'll make you feel a lot better about being hated. So if you're a monopolist, what you get is the power to set prices and nobody can do a thing. But if you're a regulated monopolist, here's what happens. Everybody still hates you. You're the phone company. You're the power company. Everybody hates you. You get ready to raise prices just like the old monopolist, but you're a regulated monopoly. You know what the regulation kicks in? Is you don't get to set prices. You have to go in front of a regulatory commission that says, this year I think we'll give you 2% price increase. Who wants this? If I'm a regulated monopoly, I'm saying give me competition any day because I'm not getting any of the benefits of being a monopolist. So if you're going to get legal protection, make sure you don't give away pricing power in return. Switching costs. What's the switching cost? You want to make the cost of switching into your product as low as possible. And then after people switch in, you want to make the cost of switching out as high as possible. Next time you walk by, Anna, what cell service do you have? Don't worry, it's not a privacy thing, right? So it's Verizon, AT&T, T-Mobile, what do you have? T-Mobile. Do you actually get service with T-Mobile, or is it just for show? I've heard about it. So let's say you walk by the AT&T. There's an AT&T store right on 8th Street. Walk by and ask them, can I switch to AT&T? You know what they're going to tell you, right? In a minute, 5 minutes later, they'll have you switch to AT&T. The cost of switching in as low as possible. And before you leave, they'll make you sign this document that runs like 50 pages. Don't even read it. It'll scare the heck out of you. But after you get home, you look at the document, you discover that you've just basically given away your firstborn, your secondborn, your thirdborn, and your fourthborn. You're locked in with AT&T for the rest of your life. You didn't know this, but who can blame them? You want to make the cost of switching in as low as possible, the cost of switching out as high as possible. In businesses which are commodity businesses, and let's face it, phone service is becoming a commodity business. If we weren't able to do this, I'd be switching from AT&T to T-Mobile to Verizon on a monthly basis, saying, oh, that looks like a better deal, and before you know it, prices for all the services would come down. It's their job to create a switching cost, and they're trying. And finally, if you have a cost advantage, build on it. First, how do you get a cost advantage as a company? It could be because of something you did in the past. So, when you look at Asia, the very first mutual fund companies that went into Asia were able to create a competitive advantage because they built an infrastructure. And because they had low cost, then they could basically sell at a lower cost and grow faster. The other way you can get a cost advantage is the way Aramco got it. Aramco, of course, is a Saudi Arabian oil company. Got an incredible cost advantage. Why? Because it has the exclusive rights to all of the oil under the ground in Saudi Arabia, the second largest oil reserve in the world, or the oil reserve country in the world. How did they get it? They were endowed the benefit. But if you have a cost advantage, there are two ways you can use it. One is you can charge a lower price than everybody else and get a higher market share, or you can charge the same price that everybody else is charging and get a much higher margin. But whatever you're doing here, you're essentially trying to take a competitive advantage and make it into something that can extend your growth for a longer period. So when you go into a company, you can try to increase cash flows, you can try to increase the value from growth, you can increase the length of the growth period. And the last thing you can try to do is reduce your cost of capital. Again, the standard way we think about reducing cost of capital is changing the mix of debt and equity. But as I said, that's not the only way. If you can match the debt up to your assets better, long-term debt with long-term assets, dollar debt against dollar assets, it reduces your default risk, your cost of debt, and your cost of capital. If you can make your business less discretionary, the products and services you offer less discretionary, you know how that shows up? The less discretionary your products and services are, the lower your beta, the lower your cost of equity, the lower your cost of capital. And if you have a lot of fixed costs as a company, if you can bring them down, you in effect have lowered your cost of capital. Think beyond just the debt ratio in terms of lowering your cost of capital. So your mission when you go into a company is to actually think about what is it in this company that I can change to increase the value of the company. This is not part of your project. So don't worry, I'm not going to add one more to-do item. But you've done a DCF valuation of your company, right? And as you did your DCF you have, right? Okay. I was just checking. There's only 2 days left, right? So when you did the DCF valuation of your company, you took a point of view about, you looked at the company from the outside, and you looked at their debt ratio and the return on capital and reinvestment rate. You plugged them all, and you came up with the value. But you always valued it from the outside. It was somebody else's company. So they refused to borrow money, or they took bad projects. There was nothing you could do. You built that into the valuation and came up with the value. Now here's what I want you to think about. I want you to think about becoming the CEO of this company that you've just valued. And then ask, what would I change about this company? And essentially every lever is now open for you to make changes. Would I go for the cash flows? Would I go for the growth? Where is the potential for value enhancement? And the answer is going to be different for different companies. So I'm going to take two companies to illustrate how this process will play out. The first is a company called SAP. You've heard of SAP? It's a German company. It's actually a very un-German German company. German companies are usually very structured, very rule-driven. SAP is a technology company. Okay? And it's a company that I valued in May of 2005 at about 106 euros per share. So here's what I'm going to do. I'm going to hit you with the key numbers that I used to value the company. And I want you to think like somebody who's going to come in as a new CEO and change the company. So I want you to look for weak spots in the company, things that you might change. So here's what the company is doing. It is a profitable company. It's an extremely profitable company. It reinvests about 57%, which is a pretty healthy amount, and makes about a 20% return on capital, which is also a pretty healthy return. Those two numbers give me a growth rate of 11.4%. So they have a high growth rate coming from a reasonably high reinvestment rate and really good returns on capital. They're growing about 11.4%. You project out the cash flows, you discount them at the cost of capital. To get the cost of capital, I took a cost of equity of 8.77% and a cost of debt of 2.39%. But this is a company that is 99% equity, 1% debt. So their cost of capital is very close to their cost of equity. I discount the cash flows, I come up with 106 euros. So let's go piece by piece. You walk into the company, first thing you're going to check is, are they efficient? Can I getting higher? The answer is they're probably running this company about as efficiently as you can. Their margins are much higher than the sector average. Then you go to look at the growth. Are they doing a pretty good job in creating value from growth? Yeah, they're reinvesting a lot. Perhaps they're not reinvesting as much as they can in emerging markets. That's their weakness. But they're doing a pretty solid job on growth. There's not much you're going to... With the 20% return on capital, you can't say, well, let's earn 35%. 20% is already a pretty hefty return on capital. Let's turn to the cost of capital. Are there some things you could change about the cost of capital? They're an extremely profitable company, right? They're at 99% equity, 1% debt. Part of you is saying, well, why don't you guys borrow more money? Now, we know this is not an easy slam dunk because as you borrow money, the cost of equity and the cost of debt go up. So I computed what the cost of capital for SAP would be at different debt ratios from 0 to 90%. So look at the second to last column. You'll see my estimate of cost of capital for SAP at different debt ratios. Right now, they're at a close to 0 debt ratio. But if you look at the cost of capital as you go down, their optimal debt ratio works out to be about 30% debt. At 30% debt, the cost of capital is 7.95%. So if you borrowed more money, the cost of capital would be significantly lower for the company. Remember, you're the new CEO. You can change the mix. So here's what I did. I went in and made two changes. The big one was I altered the debt ratio to 70% equity, 30% debt. Why 30%? Because that's the optimal. That lowers my cost of capital for the company. And the second change I made is, remember that reinvestment rate of 57%? That's already a pretty high rate, but they weren't reinvesting very much in emerging markets. So I increased the reinvestment rate mostly to capture the higher reinvestment. So it should be primarily Asia. They were not in Asia. So I increased the reinvestment rate. But to be consistent, now that I've made them go to Asia, when I did my equity risk premium, I had to bring in the higher risk premium of being in China and India and the emerging markets. So I have a higher debt ratio, which lowers the cost of capital, a higher reinvestment in emerging markets, which pushes up my reinvestment rate and growth rate, but also pushes up my cost of capital. The value that I get for SAP with those changes put in is 126 euros per share. Remember what it was with my original status quo valuation? With my status quo valuation, with the existing management running, it was 106 euros per share. With the changes that I put in, the value that I get is 126 euros per share. What should I call that difference? There are two values for SAP, right? 126 with those changes. Let's call these optimal changes. 106 with the existing management. What do you think I should call that difference? We talked about the control premium in the last class. This is the value of control at SAP. That difference, you think that works out to be exactly 20%? Right? 20 divided by 106. That's a good rule of thumb. Let's go with it. We'd have been pretty... No. But to show you there was pure chance that this happened, let me show you a different company. Have any of you been in a Blockbuster store? Maybe when you were really young, you wandered into the store. Right? And there's a point in time when Blockbuster was the disruptor. Remember that? No, it was coming in and essentially all over the country. You had Blockbuster stores in pretty much every other block. One of the fastest growing companies in the 1990s. And then something strange happened to them. They got disrupted by Netflix. Remember the Netflix used to mail out the DVDs and the original videos and you'd mail them back? And by Walmart having those little machines in the front of every Walmart where you could just rent the most popular movies for $1. And fewer people started coming into the Blockbuster stores. The only problem is Blockbuster didn't seem to notice that people weren't coming in anymore. So here's what they kept doing. They kept opening more stores. So this is actually a valuation of Blockbuster well past its glory days. So people are not coming into stores. They're still opening stores. So here's what it looks like. Blockbuster's reinvestment rate is about 26%, which means they're opening about 50 to 60 new stores every year. Their return on capital on those stores is about 4%. Why? Because nobody's coming in to rent the movies. You're paying these big lease expenses. Their cost of capital is about 6.2%. They're growing, but they're growing with a return on capital lower than the cost of capital. So if you are CEO, you come into Blockbuster, what's the first thing you're going to fix? It's not going to be the debt ratio, right? What's your first edict the day you come in? Don't open stores. Don't open. That's it. That's your entire restructuring strategy. That's pretty easy, right? Don't open stores. Don't open stores. Shut stores down. Shut stores down. And that's exactly what I'm going to put in my valuation. I said, you either earn your cost of capital, which is not asking for much, or you don't open any stores at all. So this is exactly equivalent to not having much reinvestment, a much lower reinvestment, a much better return on capital. And essentially, I'm letting the return on capital converge on the cost of capital. The value that I get is $12.47. And the value that I got with my status quo was $5.13. So what's the value of control here? It's about 150%. So if I gave you these two companies side by side and said, tell me why the value of control is much higher in Blockbuster than in SAP, the answer is the management is much more incompetent. Basically, you can see why the value of control varies across companies. It really depends on what you think about the management of the company. So when I think about value of control, that's what I think about. I think about the difference between two values. The value of the company as is, status quo value, and the value of the firm run optimally. You can take every company, including the companies you're valuing, do those two valuations. That difference will be the value of control. Of course, to make these changes, what has to happen? You have to be able to replace the management of the company, right? So when you look at your company, you can say, is there any chance of me doing that? And here are some of the things I would suggest you look at. Look at what kinds of restrictions your company has put on people trying to take it over. And those should be in the corporate charter, so you can look for that. If you have two classes of shares, you might as well give up, right? Because there's nothing you can do to change the company. The voting shares are all. It depends on how much access there is to capital in this market. And finally, it depends on how big the company is. If you're a $300 billion company and badly run, you're probably more protected than if you're a $30 billion company. So when I think about how do I estimate the likelihood of change, here are some things I want you to keep in mind. We talk about corporate governance in both corporate finance and valuation all the time. To me, corporate governance captures the likelihood of change happening in your company. And when you have changes in corporate governance rules, either because the government imposes them, the SEC imposes them, or it comes from below, that can affect the expected value of control, because the expected value of control is the product of the likelihood that you can change the company and the value of changing the company. It can show up as a function of activist investing. Notice that every time Carl Icahn targets a company and goes public with it, what happens? The minute he targets a company, the stock price jumps up because the probability of change has just shifted in that company. And finally, when you see a hostile acquisition, it's usually not just that company that's affected. So let's say you saw a small steel company being targeted in a hostile acquisition. The day that happens, you'll actually see the prices of other steel companies also go up. You're saying, why should they go up? They're not part of the acquisition. What's changed? When you saw that hostile acquisition, you reassess the probability that change can happen at the other companies. So I'm going to use this process of expected value of control, and essentially I'm going to use the probability of change happening, and I'll give you some of the things that historically have predicted when change will happen. Tell me how well or badly you've done over the recent past in terms of stock prices, in terms of returns. I can tell you whether you're safe or bad. If your stock is down 50% over the last 5 years, I think you're in danger. Change can happen more likely in a company which has been doing badly than in a company that has been doing well. Second, it seems to depend on the structure of the board. Smaller boards with more outsiders, you're more likely to see change than if you have large boards of insiders, for obvious reasons. Third, it seems to matter who owns a company. Companies which seem to have high institutional holdings see more CEO changes than companies with low institutional holdings. And finally, there are some sectors, some industries where you see change more frequently than others. So when you look at your company and say, well, I think my company could be more valuable run by somebody else, ask the follow-up question. is there a chance that change could come to my company? Because as an investor, you care. And in fact, you will see this expected value of control play out in 4 different contexts. And I at least want to get some of these context structured. The first is when you see a hostile acquisition of your company. Almost by definition, the acquirer is saying, I think this company can be run better by somebody else, right? So there's value of change. The second is, when you're valuing any publicly traded company, I'm going to argue that what you see as the price is actually a probability weighted average of your status quo and your optimal value. Sounds abstract, but I'll explain what I mean by that. The third is, if you have a company with voting and non-voting shares, as you do in Facebook or Google, I'm going to argue that the difference between the voting and the non-voting share prices is going to be a function of the expected value of control. And finally, in private companies, there's something called a minority discount. What that is if I'm trying to buy 49% of a private company, I will pay vastly less than if I'm able to buy 51% of a private company. That 2% change seems to make a big difference in my value. That's called the minority discount. So let's start with hostile acquisitions. I came up with a value of $12.47 for Blockbuster with changes put in, right? Let's say it was trading at $9.50. The status quo value is $5. Stock is trading at $9.50. You're a potential acquirer. Would you be willing to pay the premium of $2.97, which will bring you to $12.47 to acquire the company? But we played this out, right? If you paid $12.47 to buy the company, and you get the company, you've essentially agreed to make all these changes in the future, but you've paid the entire price up front. So if it's a hostile acquisition, the $12.47 is your reservation price, the maximum price you want to pay. You'd actually like to buy the stock at $10.50 or $11 so that you can claim the difference. So in hostile acquisitions, if you're helping the acquirer, you should compute both the status quo value and the optimal value. Put one number in one pocket, the other number in the other pocket, and think about where in the middle you want to end up with, because you want to negotiate for a share of the spoils. Now let's build on this. I gave you 2 values for Blockbuster. $5.13 was the status quo value. $12.47 was the optimal value. I told you the stock price was $9.50 for the company. Assume my valuations are right. And there's no reason they have to be, but let's say they're right. Remember, the price you see for a company is actually a weighted average of the status quo value and the optimal value. I can actually solve for the likelihood of change happening in my company given those numbers. And with those numbers, with the $9.50 stock price, there is a 59.5% chance that change will happen. If there's a 100% chance of change happening, the stock price would end up at $12.47. If there's a 0% chance of change happening, it will be at the status quo value of $5.13. It's at $9.50. There's a 58.5%. You're saying, why is it so high? Because I forgot to mention that this was a stock that Carl Icahn actually targeted about 6 weeks before I did this valuation. In fact, before he targeted, the stock price was $8.20, and the likelihood of change was only 42%. The minute he showed up, the probability of change jumped, the value jumped, and the price jumped with it. One final example, and then we'll end for the day. When you have companies with 2 classes of shares, voting and non-voting shares, we know intuitively that it's more valuable. The voting shares should be more valuable. But the question is, how much more value? Here's a very simple way to think about the value of voting and non-voting shares. So you guys all be non-voting shareholders, you guys be voting shareholders in a company. I do 2 valuations of the company, a status quo value and an optimal value. If you're a non-voting shareholder, what are you stuck with? The status quo, nothing you can do. You have no votes, no control. So here's how I'm going to compute the value of the non-voting shares. I'm going to take the status quo value of the company and divide by all the shares outstanding, and that's going to be the value of the non-voting shares. Now if you're a voting shareholder, what do you control? You control the change, the likelihood of change. If there's an expected value of control, you guys get all of that expected value because you control change. So to compute with the premium, I'm taking the expected value of control, and I'm going to divide it just by the voting shares. So you get that premium over and above the status quo value. So here's the last page for today. I did this for Embraer, which is a Brazilian aerospace company. I did 2 values. A status quo value of $12.5 billion and an optimal, 12.5 billion Brazilian reais and an optimal value of 14.7 billion reais. There are 242.5 million voting shares, 476.7 million non-voting shares. If you add those two up, you get a total number of shares of about 718 or 719 million. I take the status quo value, 12.5 billion, divide by the total number of shares, I get a value per non-voting share of 17.38 reais per share. So basically status quo value divided by the total number of shares. To compute the value of the voting share, I took the $2.2 billion difference between the optimal and status quo value. There's only about a 20% chance of change. Embraer is very closely held. The government has a golden share. It's very difficult to put change. 20% chance of change. Divided by only the voting shares, I get a value per share of 19.19 reais per share. I would expect the voting shares to trade at a premium of about 10% over and above the non-voting shares. But that premium will go to zero if what happens? If the chance of change goes to zero. So the Brazilian government steps in tomorrow and says, no, we're not going to let anybody change the management. The chance of change went to zero. It could also go to zero if the company becomes optimally run. So you can think of all those scenarios where voting and non-voting shares are going to trade at the same price. So I'll close with a question. Facebook has Class A and Class B shares. One has 10 times more voting rights than the other. The two shares trade at roughly the same price. Why? What are the two explanations you can give for why Facebook's voting and non-voting shares trade at the same price?
There is no chance of change.
One is there's no chance of change. Mark Zuckerberg controls 57% of the voting rights. He's saying, well, change means I've got to move them out of the way. The other, and this is the more, I think, the more optimistic way to think about it is that it's already an optimally managed company. So take a look at a company with voting and non-voting shares and think about it from this context. So on Monday, I will actually send you a presentation just for Monday. So we're done with these packets. The last few slides from this packet will be incorporated into my Monday slides because there are a few loose ends I want to tie up. But on Monday, I will actually send you a presentation probably around midday because it will take me a little while to get it updated with your numbers. And that will be the basis for Monday's class. Yeah.
What's like a reasonable value that I should get on an option for, if you had to guess?
On an option for what kind of option?
Value of equity as
so I could have a cost of equity of like 6.5, and I was thinking that's like really low because it's a high risk. Okay, so that's intrinsic value. Okay. And I was wondering for my comps, there's a handful of publicly traded marijuana companies. So should I look at pharma as a whole or like startup pharma? Small pharma? Okay. Yeah, that's it. Thank you.
Hi, I have a question about the value of a controlling share and the value of non-controlling share, that difference. Why do you not account for the possibility of timing from the controlling shareholder?
That's a side benefit. That's illegal.
It's illegal, but it's possible, right?
If you get private benefits from being